Hello everyone and welcome to SmallCap Spotlight. I'm Mubina Kapasi and today I'm in the offices of Nisus Finance, a company that specializes in real estate. Now when I mean real estate, I don't mean that they're building real estate, but they're investment managers and specialize in financing of real estate as well as creating credit solutions for them. I have with me Dr. Amit Goenka, the Chairman and Managing Director of the company. Thank you so much, Dr. Goenka, for joining us.
Thank you very much for having me on your show.
So to begin with, if you could just give our viewers a brief introduction into all the business verticals of Nisus Finance.
So Nisus Finance, as you rightly introduced, is a predominantly real estate and urban infrastructure player within the capital space, which basically means that we handle the entire development life cycle from concept to execution to delivery, where there is intervention of knowledge, intervention of expertise and intervention of capital, which is clearly the largest bloodline for the sector. So effectively, it invites us to do two things. One is on the advisory front, because when you're seeing close to 70,000 crores worth of deals a year, you find that every opportunity is unique, every problem is unique, and it requires curated ideas and solutions, which one is able to assemble because of the vast experience that one has, because you're working the landscape for multiple years. So you know exactly how people are operating in parts of the globe, to parts of the country, to various capital backing, to various structures and solutions. You're able to assemble all of that know-how and provide a very curated idea or a solution to those seeking it. So that becomes an advisory and transaction advisory vertical. What it also allows us to do is actually learn from others' mistakes. So what other fund managers are doing, what other NBFCs and banks are doing, what are they doing wrong, and how do we improvise that when we're actually coming to putting our own capital to work. So there's a lot of efficiency that goes into the advisory business. It has also formed a very significant part of our revenue for so long. Almost about 65% of our revenue came from the advisory vertical, because it's a very high value accretive business. Somebody comes to you with a 1,000 crore project, you charge 2% of that, and lo and behold, you've got 20 crores. You'll get that only if and you can do that multiple times in the year. Whereas you can put 1,000 crores to work and still get 20 crores, but once a year. Right? So therefore, obviously, that became a very large value creative opportunity for us. Of course, fund management is at the core. How do we invest capital? Where do we put it to work? So that's the other part of our business, where we employ large scales of money across multiple funds for specific urban infrastructure opportunities, which are directed at a very unique idea at that point in time. So these two ideas are really what builds Nisus Finance at the core. Then, of course, there is a separation of geographies. We've done this business pan-India. We've expanded across the realm of India beyond the 4-5 metros. And now we've gone across the border to the UAE and capturing the GCC region as a whole. So we set up operations in Dubai and offering the same twin model of advisory and investments. So effectively, it's a 4-part model between advisory and investments in India as well as the UAE.
Okay. So I see how the two complement each other, because you watch transactions happen and then you deploy that knowledge essentially in fund management. So I think that answered my next question. But I want to ask you, what came first for you in your personal career? Was it the finance angle of it or your knowledge in real estate? I just want to understand how Nisus came about.
So finance has been the core driver for me. I started the journey in finance in the late 90s, early 2000s. In fact, I was more hell-bent on being an engineer and doing R&D. I realized India does not offer R&D opportunities, and therefore, and even if you created something, the first question the management would ask you is, what is the payback, what is the IRR, what is the ROE? I'm like, what are these terms? Hadn't done all of that, so moved to finance in a very big way. Started with mergers and acquisitions, accelerated on that, and corporate finance, in investments, and saw a very large landscape of that area across the globe. Invested close to $6-7 billion across 4 continents, and that gave me a very deep understanding not only of finance but asset classes, industries, legalities, regulations, risk management, etc. So then doing all of that, obviously it was overwhelming. You are understanding multiple sectors at a time, you're trying to, but then it never gives you enough satisfaction, because you're never able to deep dive into one space. So if I'm working in the automobile market and I'm buying a car company, I can only do so much in understanding what a car company does. I can never actually be there and run it, right? Likewise, when I'm doing FMCG, likewise when I'm doing industrial or chemicals, you can only do so much as a finance professional. So I said, it's time for me to be specific to a sector. And then the question was, which sector? And I started to think, I said, well, what is going to drive the future? In my mind, the answer was clear. It has to be urbanization. While technology will be important and healthcare will be important and everything else will be important. But the end of it, if you do not have proper infrastructure, Will you get capital? The first engagement for anybody who comes to the country is the infra of the city. What kind of roads, what kind of airports, what kind of hotels, what kind of office spaces. Do you want to come into a rundown, dirty, unkempt city, or you want to be engaging with a very clean and a very, very nice looking location? So I think that was very clear to me. In 2005, Press Note really paved the way for global capital to start coming and investing in the country. And then 2008 had just happened. And what that did was it actually shifted the entire paradigm for investing in real estate, because in a lot of ways, the entire global financial crisis was predicated on over-engineering real estate investments. It was on US mortgages. So when we had RMBS, CMBS, synthetic structures, and I'd done all of that when I was in London or I was in the UAE doing investments. And I realized that this is going to be a new paradigm. It's going to bring capital, which is more serious, which is actually driving to build assets rather than only skimming returns through structures and synthetics. And that is where the next wave of development will be. And there's this journey which has just started. It's not an industry which has even formed. There are no serious players. There is nobody. There's hardly any IPO companies, hardly anybody in the public domain. DLF and some of the largest developers went public much later. So when you see this formation or this trend starting, I knew in the next 20 years, this is going to be a force of the economy. And therefore, it's better to be part of that force today and help shape it rather than just riding as part of others. And always was interested in creating alpha or a differential path. So when everybody went left, I went right. Just a rebel nature of me.
So why not directly get into real estate development? Why the finance route?
See, finance is the backbone of discipline. Because finally, capital decides what gets built, how it is built, how it is consumed, how it is perpetualized or democratized, and what are the bells and whistles required of the operator. So finance is the diktat. And without that diktat, the developer is free rein. It's exactly what happened in the first state of things. So almost, we'll be surprised, almost $13-14 billion came to the country following Press Note 2, and everything went out of the window. People lost a lot of money because there was nobody within the development companies who knew exactly how to work that rope. Even the people who brought in the capital did not know how to actually rein in the developers, how to actually get them to behave. They started learning that. They started to understand that you just cannot give money and hope that will happen. You actually have to actually produce results yourself. You have to guide the team to do it, because we've never done things at scale. We've never built 100 million square feet of office space, the size that we're consuming today. Right? So when you've not done that, how do you actually make it deliver? So capital is the driver. And unless you control capital, you can't control anything, which I learned way back in engineering days, that you need to control capital to control the organizations and outcomes. So therefore, capital became a natural part of it. The other thing is that, way back, or maybe 17, 18 years back, India was still at an infancy of development. You did not have so many high rises. You did not have data centers. You did not have grade A warehouses. You did not have, high grade commercial buildings. It was very, very rustic. It was very, medieval, very, very elementary. And so it needed to actually catch up in technology, in processes, in governance, in systems, in the ability to actually follow a certain code of conduct, which RERA brought in, etc. eventually. So without that, being part of that means effectively wasting energy on an organization or on a platform which is not going to be ready to actually deliver, because why break what is working is usually the mindset. If everybody is building it, why don't you do the same thing? So capital can change that thinking. So therefore, it was very important for me on the capital side. So really, real estate, and again, I realized also that I'm not the smartest guy in the room, Mubina. Let me be honest to myself. So if I go in technology and am I going to get an IP? I'm going to build the next Google. Am I going to be able to be a change in technology? Maybe not. But can I create a large change in urban infra? I can. And that's when I realized that, andho mein kana raja, if you are half smart amongst equals, maybe you have a better chance of going ahead. So I realized this is a great opportunity, and I found a great platform to actually exercise my knowledge, exercise my will, be experimental about it, see what is the best way to move this industry forward with capital. And that's really how real estate happened. And of course, it's a very engaging asset class. What you can see, what you can feel, what you can experience, what you can engage with, what you can conceptualize and actually see it getting done is a very new feeling. It's a new high, something you don't get to see in other sectors.
True, very true. Anyway, now you are kind of in the real estate. We'll talk about that in a bit. But the way you explained your business verticals, transaction advisory and fund management, it looked like the transaction advisory one seemed a bit more reliable in terms of your income stream. Yes, fund management, of course, is a big part as well. But I want to know what the split is, because as I understand, fund management is getting bigger and bigger. Understandably, for obvious reasons, right? India's urban infrastructure is booming. So you're one of the beneficiaries of it. So how would you look at this mix changing? Would you be worried about that predictable source of income perhaps pausing for a bit or getting lesser?
So I think while both are important, see what advisory did for us, of course, apart from being very strategic in terms of knowledge enhancement, gave us very large streams of income over very short periods of time. And that allows us to always stay very positive and growth oriented. But what AMC does is it gives you very long-term annuities. So let's say when I manage, for example, 10,000 crores and I'm earning, let's say 2% a year. I know I'm going to continue to earn 200 crores a year of annuity for the life of the fund, which is 6 or 7 years, without worrying about whether transactions are going to happen or not. So it gives a very long stream annuity for me, which is very important because it then sort of cushions your downturn. It cushions all cycles. You know your cost base and your profits are covered at all times.
So I got it wrong, actually. This part of the business gives more predictable.
That's right.
All right.
That's right. So the predictability of AMC is obviously a given, which is why it needs to be obviously larger. And it is happening like that, So the markets always question, when will AUM become large enough that it becomes the most significant part of your business? And it will at some point. But then losing transaction advisory is a bad idea because it gives very significant jumps. Also, we've also demonstrated over the last 15, 16 years, Mubina, that there's a very strong correlation between advisory and investments. See, what happens is when you're putting, let's say, 1,000 crores to work, the type of deals that will come to you are also which are going to fall within your bracket. 50 crores, 100 crores, people, because they know this is what you can do.
Yes.
Now that's the deal flow you're going to get. Now within that deal flow, you'll end up maybe doing 2% of those deals. The rest of the 98% can become potentially your advisory clients. So the larger you become, the larger value and volumes of deal come to you, and therefore the larger the advisory income. So we've always shown there's been a constant correlation between how much AUM you manage, how many products you manage, and what kind of advisory income you generate. But having said that, but you cannot obviously grow at the same speed as AUM, right? So when AUM is growing faster, obviously today the ratios are shifting from 65-35 to 50-50 and potentially 60-40 in favor of fund management over the next 2 years, which is also great because it gives you very long-term annuities to begin with. So both are very important drivers, and which is why now accelerating both of them in the UAE also ensures that there is significant ratio of advisory, but the AUM continues to grow across markets.
So you know what my next question is going to be then. What is the current AUM and what targets have you set for your AUM in perhaps the next 3-5 years? What do you think is going to drive the growth there?
Mubina, it's a very interesting question. It's also a very scary situation because the speed at which the economies in which we are growing and the space is growing. Today, India is targeting $1 trillion asset class within urban infrastructure and real estate by 2030. UAE is targeting $2 trillion. So in the next 4 to 5 years, we're looking at a $3 trillion potential. Combined today, they're roughly at about $1.2 trillion. So from $1.2 trillion going to $3 trillion is a very large growth potential for all of us. How much can we do again is a function of our capability, our speed, and our focus. Having said that, of course, one doesn't want to do too much too soon. Otherwise, we risk breaking the model very quickly. Where we are today is at 1,900 crores as of the first half of this financial year, potentially accelerating to 4,000 crores in the end of this year, to doubling that over the next 12 to 18 months. And that again, I think may be conservative in some way because, as I said, the opportunity is absolutely stunning. I have seen pairs who've grown from 2,000 crores to 60,000 crores in a span of 7 years. And this is only India. We could do similar numbers, or we could do more, or maybe even slightly less. But that is with the scale at which one is able to grow. Because the interesting part is that pre-2020, after the spate of all of these surgical strikes and regulation, demonetization, etc., the market started to consolidate, shrink, and favor the stronger enterprises. Post-COVID, the reality has even been grimmer, where the weak players effectively went out of business. And it's only the large branded, corporate governed enterprises which are in play, which means 52 investment companies have shrunk to less than 15. Now, we are part of that few who are now slated for growth irrespective because we withstood time. We've withstood our performance. We've stood the test of what it means to actually deploy capital at scale in a clear, transparent, integrated, and committed manner. So given those check boxes, which are today mandatory for domestic or global institutional capital, I think we're today slated for a very high growth. And again, it's multi-product. Most investors, fund managers, investment houses, NBFCs typically focus on one strategy or two strategies. Today we have multi-pronged approach, which is a solution capital. So when we see a very large growth in industrial warehousing, data centers, plotting, low-rise developments, one is actually targeting that in a very specific way. When we saw a slew of NPAs, a slew of IBC matters, a slew of issues with NPAs and projects stuck with banks or asset reconstruction companies, we started targeting that and rescued a bunch of that. So given the solution-oriented capital, which is really what the country needs, one is able to actually grow 10 times without a problem. So clearly, I think it's up to us to see when can we reach from the first 10,000 crores to the next 20,000 crores. And I think it's within this decade.
Okay, awesome. You had your IPO and you're, I think, one of the first, correct me if I'm wrong, but I think you're one of the first listed businesses who is so specifically focused on real estate solutions.
Yes.
Or the only ones. Yes, there are other listed players, but then they have several verticals.
Right.
But yours has a more focused approach in this particular sector. Do you think that is also in a way a competitive edge when it comes to attracting investors? Because obviously being listed, it lends you a certain credibility. And in the same tone, I'd like to understand from you, what is your competitive edge there?
Yes, while listing does add credibility, but again, it was more to understand what is it required to be the best in our country. And for that, you'll have to look at global templates, right? Because clearly, we're going in a certain direction when we look at globalization. Yeah. We're looking at the best of breed solutions and platforms from global landscapes. So when I saw that a lot of my peers, a lot of the other players in the country that came in, whether it was Brookfield or Blackstone or KKR, were all listed in their countries. I said, why are we not like that? When you have global players who can come to India and make a large impact, why can't domestic managers do the same? And for that, you need to first build credibility, because that's what we've never built. Fund managers never build credibility for themselves. Everybody felt they were only here to earn their 220 and not worry about capital. I said, I will put my money first. And my 100% money went into actually our funds. And I have no other investments except for what we do. Zero. So I said, first, let me put everything in. That means I'm committing myself to this particular product and this platform. That is the first starting point. And then listing determines the ability to actually play at scale in a very transparent look-through manner. Because everybody felt it's a black box. You will take my money. After 1 year, I'll get some report or NAV report. And then I'm lost as to when I'm going to get my money back and when I'll actually make real returns. Yeah. It's all paper returns, right? And I don't know whether it's genuine. I said, that can't work. You have to be able to show exits. You have to be able to show real bankable in the money returns. You have to be able to show how you're actually moving your strategy from visioning to execution. And I think that's really where the listing works, because it also gives you full look through into what am I actually doing? What are my earnings? Where is it coming from? Am I actually shafting the investors, or am I actually doing them good? How much of my own money is in play? Am I just saying it, or am I actually doing it? So when everything is available for examination and scrutiny, there's nothing left to hide. And that is the only way when you can start becoming global, looking global, following what the global majors have done, which is why they're global, which is why they're scale, because they are willing to put everything down and say, this is who we are and come play with us. So it was definitely a very big step to make that happen. Credibility, yes. So Mubina, India has so far been dominated by banking players who are allowed to do everything. From banking to private equity to alternatives to mutual fund and what have you. And the US realized that many, many years ago, post the 2001 crisis, that there has to be a separation, and Glass-Steagall Act happened. And that's when all of these major alternative managers, whether it's a KKR, Brookfield, Blackstone, etc., started to become very big. That is bound to have happened in India as well. There has to be a separation in conflict of interest. You cannot have your depositors getting sold a risky product. Because you're a banking client. So there has to be separation of conflict of interest, and which was not happening. So realize that what is now being seen in the private equity space, where you have large players were not necessarily banking players, because the good part was that the banking guys never really understood private equity, because they were lenders by profession. They understood credit, they understood real estate, they've lent this to them. But they never understood private equity. So at least private equity started to form independent platforms. But nobody became large enough to become a soft bank. So I said, we can become a soft bank also from here. When it comes to private equity, we can become a Brookfield, Blackstone, KKR, or anybody also from India. So therefore, also when you do that and when you list it, you are able to say that I'm willing to compete on the same terms, on the same lines, with the same disclosures, and be an independent manager without having any conflict with anybody else. So that credibility building was very important, because then you get discovered. Because then you have global audiences looking at you, then you have global investors looking at you, you have global private equity funds looking at you and saying, oh, okay, now I understand what you are saying. Otherwise, you're a mouse squeaking from the corner, but now you have come at a stage and now we can hear you better, we can see you better. So that visibility was very important. Credibility was built on track record, but the visibility became much larger. And that was now very important, because now we become a bigger magnet for global and domestic capital.
I want to talk about your framework for when you conduct a private credit transaction, because at the end of the day, that's what your business is built on, right? You have to identify the ones that are going to be tomorrow's stars and help your fund perform. So if you could share a little bit of a glimpse into how that thinking works, and how do you decide whether an asset is worth your time and money or not? If you could share a little bit.
Sure. See, underwriting is a science and an art. There cannot be any formulaic or any sort of an algorithm which can tell you, unlike in standard credit underwriting, well, algos can take your credit history, your asset value, or your bank account statement and discipline, give you a credit score. This goes beyond that, because you're actually investing or lending to someone who's trying to deliver a certain outcome. In doing that, obviously, first the counterparty's track record is very important. How solvent or how credible they are. And which means on the ground grassroots intelligence, getting to know what is not published or available. So that is the most important force. The second becomes our ability to actually sensitively manage every variable in the play. So when you look at any project and you say, how is the risk management going to work? What is it that we are able to control? How do I ensure 100% that we will exit at a particular date with these returns, irrespective of economic, geographic, or any other environment or regulatory environment? So when you have those frameworks of risk management in place, which is doing very, very high level stress testing on the counterparty, on the asset class, on the opportunity, and on various other aspects which goes into delivering a project, then you know that when it comes out of a stress testing framework, it stood that for 2-3 months, then it has a very high chance of actually succeeding. So that's the first part, which is the credit underwriting. The second part is in making it happen. Today we are the largest team in the country, managing less than $500 million. Today we have a team of 60 people. Now 60 people typically worldwide would be managing 600 billion, or 60 billion to say the least. So when you have that kind of bandwidth, 800 man-years of people sitting behind every investment you make and ensuring 24/7 that, boss, you have to deliver this. You have to sell this much. You have to collect this much. You have to ensure this money comes into the RERA escrow account. You have to ensure that this completion date happens by this date and time. So when you have a very large talent pool which is looking at legal, regulatory, technical, marketing, finance, credit, all of that on a 24/7 basis for each of your investments, then you're effectively driving your own outcomes. You're not leaving it to market and chance. So that is the second and most important part, is actually hands-on engagement with our investments. The third is, of course, my own capital at work. As I said, if I lose it, where am I? As a first generation entrepreneur, either it's make all or lose all. So that fear factor will always be there, which is important as well, I think. And lastly, we are built around a singular idea of investments into a certain asset class. And that's what we do. So we have no other diversification. It's not like we're running a mutual fund and we are running, by the way, another PMS vehicle, and we're also running insurance, and we're also doing banking. So one doesn't work, it's fine. So all our exits are in this one basket, and therefore you have to protect it with all your might. For that, the ability to actually engage with all that matters, from a regulator to bankers to developers to marketers to influencers to economists to industry bodies, becomes very important. So we've created a very cohesive ecosystem around us that keeps us sharp, that keeps a very strong alignment of interest along with us, so that if we succeed, they succeed, and vice versa.
So you learned from your transaction advisory, applied it to fund management, and clearly you're learning from your fund management and now the acquisition of NCCL.
Sure.
So I'd like to hear a little bit about that. What was the rationale behind that acquisition, and how do you see that business grow?
Again, something we didn't sort of think about even not less than 2 years ago. And which is why it's not part of our IPO objects, because we didn't know we were going to do this as late as December 24 when we went public. It happened, but it ended up happening in August of 25. Yeah. But it was very clear to me that what are we? We're solvers of problems. That is what we are at the core, and we're great solvers of constraints. So whether it's our advisory, whether it's our capital is not standard capital. You can't say, oh, I want a home loan and let's go to Nisus Finance and give me the largest amount of loan at the cheapest price. We're not that. Or we're going to give you the best LRD. Or we're going to give you the maximum amount of construction finance for the next 10 years at 8% or 10%. No, we're not that. That's banking. We're solution capital. We'll try and solve for a certain set of problems, a certain set of opportunities. So that's exactly where I saw the biggest constraint today was actually delivery. Mubina, when you are moving, and if you see the balance sheets of largest of the developers in the country, everybody has gone from selling 7,000-8,000 crores of inventory to 20,000-25,000 crores of inventory in less than 2.5-3 years. How do you do that? You need to deliver. You cannot have a spate of uncompleted projects. And for that, you need capacity. And we don't have the capacity. So therefore, if you can own capacity, then you're going to rule the roost. So I saw now that there is today the availability of capital. It's come in reasonable quantities. Credit funds have been raised, private equity has come back, but in a bigger way, fewer players. We've increased our book size. So capital is available for the worthy, and capital markets have been very vibrant. Number of developers have gone public. Their cap table has become far stronger. Their ability to raise capital has become much better. So capital is not a constraint. Demand is again not a constraint because you don't have inventory overhang. I remember way back in 2010, we used to say, oh, Mumbai 7-year inventory overhang. We made stock for the next 7 years. Today we don't have even 17 months. So demand is not a constraint. Even though prices have gone up, it's become so expensive. I don't know who's buying it, but it's getting sold nonetheless, right? Offices are getting consumed nonetheless. You know, warehousing is full nonetheless. So demand is not a constraint. Capital is not a constraint. So the biggest constraint is delivery. So if you can own that piece, so you own the capital, you own the ecosystem, but the constraint of delivery is very important. And we saw that first hand during COVID. We were stressed about ensuring the projects complete. The money was sitting in the escrow. Customers were waiting for delivery, and unless the delivery happens, you will not get paid back. And the contractor would not show up, and he would not pick up our calls. And I said, this is not happening. We need to be able to control outcomes, because that is the risk factor we never thought will happen. We never thought that if you're paying contractors, they will not come to the site, they will not deliver, we will have a problem or constraint of supply. So that's really when I realized that if you can control that, we can obviously scale up. The second thing is also creating an ecosystem. We believe in creating something which is far more enabling. Now we have common clients, right? We have the same counterparty, we have the same developers, we have the same people and then we have our own order book. So when I'm lending 2,000 crores in private credit, I'm effectively delivering 4,000-5,000 crores of effectively GDV on the ground. When I'm doing that, they also need a contracting companies. Again, they're all stuck. So I said, what if I can own one, provide it to my own investee book, accelerate this, and therefore unlock value for one of the oldest construction company in India, an 80-year-old company with a strong legacy. So then it became a very strong win-win where you can cross-pollinate clients, you can cross-pollinate order books, you can cross-pollinate the new things that are getting built on the ground, which we are seeing, we are witnessing, we are investing into, and bringing the same solution for this company to construct, build and deliver. So therefore there was a very large synergy between our companies, which I saw. And of course, the good part was that I've known them for 15 years. So there's a lot of familiarity about this company, what it did, how it performed, what were its strengths, etc. And therefore there was a unique God-given opportunity when the promoter said, you know what, I'm willing to exit, I'm 92. And I said, well, then this is a God-given signal. Let's not let it go away. And so we put in a lot of effort to work this, come up to a price that made sense, be a part of the entire structure, and get the buy-in of the management, because they were the ones who've been running this company for the last 35, 40 years. And get their buy-in, have a management-led buyout, enable them, give them the opportunity to now scale to what is the potential of this company is again very, very exciting. So we're builders by definition. And if our capital and our intelligence can actually work in our favor, to unlock value and solve one of the biggest constraints. And by the way, we will be surprised that constraint is even bigger in the UAE. At least in India, people tender. When a Lodha went for a development, they tendered and our company won the bid. But in the UAE, there's no tender. The contractor decides which project they want to build. And that is the opportunity there. I said, I'm already there. I already have my friends who are doing large development. And they're not asking me for money. They're saying, Amit, can you bring your contracting company? So I'm like, wow, this is amazing. You're now addressing a $2 trillion market which has zero contractors. The 3 companies from China are exhausted. The 2-3 companies from Saudi are exhausted. Arab Tech and some of the old players are gone. Where will they complete that volume of work?
What do you think is the reason for that? It's clearly a great opportunity. You mentioned $2 trillion, $3 trillion of infrastructure coming up in Dubai. So why is it that no contractors willing to...
See, the scale at which things have accelerated are unprecedented in history. We've never had this scale up in urbanization. Today, UAE was all about Dubai. Today, UAE is about Abu Dhabi. It's about Ras Al Khaimah. It's about Al Quwain. It's about Sharjah also. So when you have 5 Emirates accelerating 24/7, how do you get this capacity overnight? It took this company 80 years to build itself. It's taken L&T 76 years to build itself. It's taken Shapurji an equal amount of time to build itself. These companies take a very long time to build the capability, bring people, processes, systems, vendor management, technology, deliver it in a certain framework with risk, safety, getting bank credit lines, very hard. So it is very difficult. It's very easy to buy land and sell. But the hardest is to find the entire organization which can actually complete it.
Execute.
And that is very hard, which is why somebody has to then say, oh, let me get some labor, let me get some material, let me get something else and try and aggregate it and somehow get the project done. Because that's the only other plan B. So because scale has happened so fast, it has been very difficult for people to actually get that capacity built overnight. And of course, you want to trust a person with the necessary background, with the necessary track record. Now, you can't build track record overnight. Those who have track record have already filled up their books. They don't have any more capacity. So then how you want to build more overnight? So then fortunately, we have a company which has capacity.
Yeah. I want to know how you look at debt, because NCCL does have debt on the books. And I know you trimmed a little bit of a stake to pay off that debt. But in a way, debt is going to be a part of, the construction business too. So I just want to understand, how are you looking at leveraging and debt?
Sure. It's a very important question, Mubina. And it is where the value driver can be or it cannot be. So debt is a good accelerator for returns to equity. But too much debt can obviously kill it.
Yes.
And we've seen enough organizations who effectively are sitting in insolvency because of debt.
Yes.
Because of bank NPAs. So when it comes to us, while we're lenders by choice, and we put out a very large sum of money in loans and we understand credit really well, but we're not natural borrowers ourselves. Because we understand that we're not a full-scale NBFC where we need to borrow 6 or 7 times of our tier 1 capital. We need to manage credit on the asset side as well as on the liability side, work on NIMs, work on NPAs, work on prudential norms. So we don't really have to do all of that. Largely all our capital, when it went to credit, is all equity linked. And because it is equity linked and sitting in a fund, we're deriving fees from having putting this, sort of sums of money to work in the marketplace. But debt is good because it helps you sort of preserve equity to some extent without diluting it, which is how venture debt also came into being, so that you don't keep on diluting to raise more and more growth capital. But of course, it has to be serviceable, which means unless there are strong cash flows to back your debt, which is very predictable, very, very solvent, has enough and more cover to how much debt you're taking, it becomes destructive. So when we borrowed, of course, for the first time to actually buy NCCL, we were very clear that we'll pare it down in actually no time. Because we have very strong cash flows. We have the ability to raise equity because I've only diluted 25%. So if need be, I could further pay down my equity if needed, which is I don't think is a necessity. But instead of liquidating myself or paring down my equity stake, I could raise short-term debt, and which is what we did. We've effectively reduced that. And so that debt that we took on our books was not for the purpose of Amit Goenka as a promoter, but was to allow Nisus Finance as a company to acquire the construction company. So effectively, I created a pledge on my shares to a certain extent, allowed the company to borrow against that pledge, that allowed us to then go ahead and acquire this company, and of course it has become a great acquisition, and which also immediately, because the company has significant cash flows, has reduced that debt to half, is effectively going to kill it over the next few quarters, and that will eventually release more of my share pledge, which has anyway come down significantly. So that was the first time we actually really went into any borrowing mode, and which is why we got ourselves credit rated also for the first time, which was a very fantastic outcome. So while leverage is important in our business, we actually don't need too much leverage. Okay. Second is, as far as entrepreneurial goes, again, I'm trying to deleverage it. See, because it's a volume business, it's not a margin business, and you're effectively generating anywhere between 10 to 12% EBITDA margins, maybe 14% if you're doing value-added construction. Now, the difference between your EBITDA margins or your operating margins and your profitability will finally depend upon your cost of borrowing and your leverageability. And that can shrink it massively if you're overgeared. And which is what the opportunity we found with this company, that we can actually massively change its gearing structure. We can actually massively reduce the total debt overhang in a very short period of time, because there is a lot of assets on the book. You just need to unlock it. There's a lot of fixed assets. You need to sell it off. You don't need them, right? There's a lot of guarantees which are outstanding, which you can be reduced. There are income tax refunds, which we didn't get for 2 years, and suddenly in 2 months we got it back. So it's just about focus. Can we get this back? Can we get this back? Can we get this back? So there's a lot of value sitting on the balance sheet, but it is locked in the balance sheet. When you start unlocking all of that, effectively your debt starts becoming zero. The good part about the sector is, and the way it was also running in the UAE, is that you actually don't need bank debt. You must have some, because you need guarantees, you need working capital, you need to accelerate, you need to move the order book from a current 2,500 to 10,000 crores of order book. So you need some gearing. But the cost of that will come down, and the need for that will come down over time. So debt is most effective when it goes into a large capex, because it helps sort of leverage your asset. It helps you build a large asset. Like we took leverage to build this asset, which is acquisition of a company. But it must be manageable to it must be pared down very quickly and kept constant at a very small ratio, which is only enough to keep it running without really destroying your earnings or your profitability.
I want to get a macro picture from you, since you're in this business. How do things like interest rate changes or any other macro changes, for that matter, even SEBI regulations, because you're, a fund management firm, how do these things affect your business, and how do you view them? Because again, because it's real estate, you're very dependent on things like interest rates. At the same time, you're a fund. So you're also looking at what SEBI is releasing in terms of regulations, circulars. So I just want to understand your take.
No, absolutely. I think key economic policies, policy rates, regulatory actions are obviously very, very strong determinants for how we're going to continue to scale this business, and what is going to be eventually our profits and our margins, and what we can deliver to our investors. Having said that, one thing is for certain is that policy rates have usually helped us. When there is an interest rate tightening or when there's a liquidity crisis, we become more popular. There's a need for people to go to alternates even more. In low interest rate cycle, obviously the demand becomes lower. There's some amount of yield compression that happens also for us, because we do maintain a spread over policy rates. So banks will maintain a spread of, let's say, 400, 500 bips over policy rate. We will maintain another 400, 500 bips over policy rate, which is why a second fund, which typically our funds have done 20% plus, actually fell to a 16-17% return during COVID time, because the policy rate suddenly fell for a period of 1 year. It was the lowest interest rate regime in the country to help the COVID environment, and therefore correspondingly our portfolio yield also compressed. Also, the demand also became slightly more muted, because people are afraid to borrow when they don't see visibility of business. So those become, but having said that, because it's structured credit, one is able to today curate a solution which is able to actually match the outcomes for projects. Which banks can't do, which NBFCs can't do. They need to get paid interest every month. They need to get their EMIs done. They need to get returns in a certain period of time. So as a SEBI EIF regulated fund, we have a far greater flexibility on how to structure our credit. We've done listed credit, we've done unlisted credit, we've done private lending, we've done all sorts of things. We've partnered with ARCs, we've partnered with other institutions, including larger government-led funds. So because it's solution capital, and therefore the ability to actually curate the outcome becomes slightly more agnostic to policies, or at least policy rates, because you're able to find something which is eventually going to happen over the next 2 or 3 years, and then work your product accordingly.
So in a way, by customizing solutions, you are being able to manage the risks associated with cyclicality.
Absolutely, Mubina. I think that's one part. Second, when it comes to SEBI, I think one thing is certain: we will never do business which is not regulated and has not seen enough regulatory intervention.
Okay.
So even when AIF came, it was the best thing that ever happened, because so far people were not sure how to actually run pool vehicles, either through a PMS or through a VCF. So when AIF came, I knew this was going to be a game changer. And we are the first AIF fund manager in the country to actually apply and get an AIF license, become an alternate fund. And so being a fund manager for the last, now it came in 2012. So for over 14 years, we've been actually managing AIF funds. So therefore, we have that track record. Also, when fractionalization happened, I did not enter that space because it was unregulated. Likewise, when people started to do other sort of distribution business, we did not get into it because it was unregulated. And I know regulators will sometimes react and not proactively build regulations. But when they react, you don't want to be on the wrong end of the curve, right? It can pretty much kill your business.
Yeah.
So we never got into activities which were unregulated. Today, when an SM REIT regulation in place, today we have the ability to actually do fractionalization through an SM REIT model. So that's a great thing to do. So I think regulations are very important and they have to be tried, tested and understood really clearly. Second is, I think SEBI has become very proactive. They've always been a great regulator. But obviously when you set up a product, it takes time also for the regulator to understand how a product will actually behave. What could be the challenges. Today, the way they have created the framework, which is constant audit, constant checks and balances, constant queries, constantly understanding whether you're doing a fair job in line with your regulations, has become a standard feature. Earlier, you used to never see SEBI's face after you got a license. Today, they're in your face 24/7, which is amazing. So I think a lot of compliments to the way regulators work. So, and I think more importantly, because we've kept governance at the core of our business, their changes in regulation never affected us. So, example, they prevented evergreening. You cannot roll over your investments or loans from fund A to fund B, and therefore keep on evergreening and not have NPAs. Just the way banks did, right? We never did that. So, I was very happy that it happened. We need to constantly value and report. We did that. So, we were very happy that finally they are asking the markets to also behave in the same way. Disclosures of how much is your money, how much is others' money.
You're ahead of the regulatory curve.
So I think it is, when you're doing your business with the highest levels of integrity, governance and reporting, then these regulations are a great welcome change, because it means that those who are getting extraordinary benefits for not following rules are falling in line. And because we're already in line, we know how to really work the ropes. So there's no cost to that learning. So I think generally, I think the regulators doing great. And of course, so I think the outcomes have been more positive than not. And again, because you're in constant discussion, you know how the regulator thinks. You know what they don't like. You know what they like. You know what they expect. So when you understand the spirit before the letter, and you start following the spirit, you're always going to be on the good side of the regulations.
Fair enough. All right. My last question to you. I mean, you've noted down what your ambitions are for Nisus, for NCCL. I'd like to understand a little bit more about your team, because, of course, even your team, which mostly, I'm sure, consists of real estate experts, investment management experts, they're the ones who have to take forward the business as well. So I'd like to understand who forms a core part of your team. Is there perhaps even a succession plan in place, if there is one in place?
I think it's a fantastic question, and I think that's one thing which keeps me awake, is succession planning and leadership building. We do have a significant leadership team in our company, and very, very proud of that. We built team over several years. And I think it is to do with what I have faced and what I need my team to have. So, for example, most organizations have very, very strong rail guards on what can happen or what can't happen. It kills innovation. It kills the liberty to actually scale or do things that make sense. So I think creating empowered teams has been one of my biggest joys of life, is finding the right people, getting them empowered, getting them to build their teams, giving them the flexibility to celebrate their failures and celebrate their successes. So I think that's a very important part. And again, when you start giving people the liberty, and I think it's very critical for me that everybody in the organization must do everything that the organization does. You got to be involved in sales and marketing. You got to be involved in credit underwriting. You got to be involved in regulations. You got to be involved on the legal side of things. You got to be involved on the media side of things. You got to be involved in the public fora. You got to interact with the industry and go out and meet people. So when you do that, you start realizing that some people have strengths in domains that they did not come from. Somebody was great at marketing but was a financial analyst. Okay, somehow he never thought that he could actually also sell, or he could market, or he can present so well. So when you see that, you are able to unlock truly what that person is best at, where his joy lies, what makes him happy and glued to his work, rather than trying to run away from his desk at 7 p.m. or 6:30 p.m. So I think that ability is something that is a constant endeavor, and people have rotated themselves. They found the right spot. They've done what they really like, and accelerated themselves to do that while working in a cohesive environment, because they've gone around and done everything else. So now they can seamlessly talk to their peers. They're not afraid of talking to legal or accounting or compliance, because they know exactly what these guys do. They've been part of those journeys also. So I think that is where the value lies. That's where the appreciation for your peers is, where the mutuality is, and therefore everybody jumps in when there's a problem. They're not saying, "What's your job? If there's a compliance problem, go deal with it." Everybody becomes part of the problem and the solution. And I think that's where the enablement and the joy is. And I think that's where we create enabled teams. And of course, sharing successes. We believe that success should be shared bottom up, not top down. Typically, leaders like to wear the hats or the crowns or the sashes, but we allow the teams to wear that first. They are the ones who actually. So when you work with the lowest denominator in wine and the highest denominator last, and when the leader is just effectively a mentor and a guide and not a manager, that's when people feel responsibility, accountability, power, and the enablement to do what they really want to do in their life. So those who really want to do something and love what we're doing and are able to sort of do more of it will definitely stay with us forever.
All right, super. Dr. Goenka, thank you so much for your time, sir.
Thank you, Mubina. It was a pleasure talking to you, and all the very best.
Well, there you have it. That's Nisus Finance for you. Do remember, folks, that this is not to be construed as investment advice. Kindly conduct your own research. Thank you so much for watching, and stay tuned to SmallCap Spotlight.